Right, good morning, everybody. My name is David Warnicker. I'm a tax partner at BDO, and I'd like to thank you for joining us this morning. It's difficult to believe that it's that time of year again when we go through the more important of the amendments that were proposed in the Taxation Laws Amendment Bill and the Tax Administration Laws Amendment Bill. These bills were introduced into Parliament by the Minister of Finance on the 1st of November 2023. And that's what we're going to be dealing with in the main today. For those of you who are new to BDO, just some facts about us. BDO is the 5th largest network of accounting firms in the world. In South Africa, we employ more than 2,000 staff across 7 offices. BDO South Africa is supported by significant global resources with 1,800 offices in 164 countries around the world, and a global revenue of nearly $13 billion. This morning, I'm joined in the presentation by 4 of my esteemed colleagues. I'll briefly introduce them to you in the order in which they'll be presenting. So first up, we'll have Dumisa Sihao. Dumisa will be presenting on amendments relating to individuals, savings, and employment. He's an Associate Director at BDO, and he's BDO South Africa's Head of Global Employer Services. He's a seasoned expatriate tax and employment specialist with over 18 years of experience. He joined BDO in 2020 as the Head of the Global Employer Services Department. And previously, he worked for Deloitte in the Africa Tax and Legal Employment Tax team. He focuses on assisting multinationals with their employer obligations, not only in South Africa, but in the rest of the continent as well. After Dumisa, we will have Louis van Maanen. Louis will be presenting on corporate income tax and related amendments. Louis is a partner who mainly deals with corporate income tax. Louis qualified as a chartered accountant in 2005. He joined the firm's tax consulting department in the same year and obtained a higher diploma in tax law from the University of Johannesburg in 2007. He has extensive experience in corporate tax matters, covering a broad range of industries and economic sectors, servicing clients ranging from large JSE-listed companies to small public benefit organizations. He has consulted to more than 50 listed entities on a variety of tax matters in his career to date. Then Hilton Cameron will present on international tax aspects of the bills. Hilton is a director who is our head of corporate international tax. After qualifying as an attorney, Hilton joined the BDO tax consulting department of a large accounting firm in 1999 before moving to BDO in 2008. He specializes in inbound and outbound acquisitions, double taxation agreement interpretation, mergers and acquisitions, intra-group reorganizations and implementation, and general consulting. Then Cliff Watson will present on indirect taxation. Cliff is a director in our indirect tax division. He started his career at the South African Revenue Service, where he worked for 11 years. He successfully completed all relevant indirect tax courses and gained vast experience in SARS's audit and general processes. He then joined Deloitte, where he consulted to large corporate and multinational clients on the VAT implications of their South African and cross-border operations. He has excellent knowledge of the South African VAT implications of import and export transactions, having completed several customs and excise courses. Cliff has expanded his capability to include the specialized area as well. And then I will come on to discuss 2 important tax cases decided during the past year. As mentioned, my name is David Warnicker, and I am a tax partner and head of income tax technical at BDO. I'm also chair of SAICA's National Tax Committee. I've nearly 30 years of tax experience in consulting to large listed and unlisted entities and individuals on a wide range of tax issues. And then just before we start, lastly, some housekeeping notes. Firstly, the session is being recorded, and the link to the recording will be emailed to you after the session. If you've got questions, we welcome them, and please submit them through the Q&A function that you can see in your Teams link at the top, Q&A. Not the chat, please use the Q&A for that purpose, and we will try to address them as we go along. And then CPD certificates will be emailed to you after the session. So without further ado, I now hand over to Dumisa Sihau to deal with amendments relating to individuals, savings and employment.
Thank you, David. Good morning, everyone. As David has said, what I will be covering today will be in regards with individuals, savings and employment. And there's been quite a number of changes that do impact us as individual taxpayers. And the first one really is in line with what has been happening with the recent changes in South Africa around individuals ceasing to be South African tax residents. I can get the slide. So what has been happening in recent years when SARS changed the laws, especially with regards to Section 10102, a lot of individuals started ceasing to be South African tax residents, and there was actually a proper process that was followed by SARS to effect the cessation of residency for individuals. What that means is that an individual then become, if they cease South African residence in the middle of the tax year, they actually do have 2 tax years in terms of the law. What then this created in practice is that if an individual, for an example, had a tax-free savings, they could actually double dip in this because the limitations were actually not put into place to take into account the 2 tax years. And what happened is that because an individual had 2 tax years, they could actually, from a retirement fund contribution perspective, benefit from the 350,000 in both of the tax years, and therefore SARS has had to make these changes to actually cap that anomaly. And what happens is that if an individual has 2 tax years, what happens is that their contributions to retirement funding will actually be kept at 350,000 rands for the 12-month period and not per tax year, as it usually was the case. And this is also the case when it comes to the tax-free savings, which is at 36,000 rands amount. And therefore, if an individual has been a resident up to, let's say, the end of May, what would happen is that from 1 March to 31st of May, he will be a resident, and then from 1 June to the end of Feb will be a non-resident. But what then would happen is that whatever they've contributed, let's say it's 5 months out of 7 months. For the 5 months, it will be 5 months times 350 over 12 months to make sure that the 350,000 is not utilized in both the tax years, but a portion relative to the number of months that the person was resident will be utilized. This is then therefore to make sure that everyone gets the 350,000 rands deduction and not anything more than that, as well as the tax-free savings contribution, in that in every 12-month period, it will be kept at 36,000 rands. This change will actually come into effect from on the year of assessments starting from or after 1 March 2024, which is the following tax year, which starts in a couple of months' time. The next change is with regards to loans that have been advanced to trusts. Next slide, please. So previously, there hasn't been very clear guidance when it came when we were dealing with loans that were denominated in foreign currency, and SARS had actually had to put measures to ensure that when a loan has been advanced to a trust, this loan is accounted for properly, and SARS has made a proposal in that if a loan is actually denominated in foreign currency, the average exchange rate for the year of assessment is actually used to actually denominate that loan into the South African rands. And if this loan is interest-free, there is what we call a deemed donation, which is the interest at the official rate minus any interest rate, any interest charge. So if there was no interest charge, therefore the deemed donation would be the official interest rate, and that would be then deemed to have been a donation. The second anomaly that was created that didn't align with the H schedule is a loan that related to a primary resident. And what has been proposed by SARS is that if this loan has actually been advanced in acquisition of a primary residence, there would be an exemption. However, this exemption states that their primary residence should not exceed 2 hectares of land, and any funding advanced to effect improvements to primary residence will also qualify for the exclusion on this deemed donation. The effective year of assessment, the effective date of this change will be on or 1 January 2024, which is in about a month's time. So therefore, any loans that have been advanced would actually qualify for this exclusion when it comes to primary residence. And the next change is with regards to our energy crisis. If we can go to the next slide. This was necessitated by the amount of load shedding that as a country we've experienced. And what then the Minister and National Treasury have decided is to provide a credit for any individual that have actually put up solar systems in their homes. There are various requirements for this credit to actually be applicable. And one of them is that it must be a new or unused solar panel that is acquired by an individual. So it is very important that these requirements are met. Secondly, there must be a minimum generation capacity of not less than 275 watts per panel of these solar panels. The panels must actually be used for domestic purposes. It must actually be installed in your home and not for business purposes, because that is taken into account on the business side of things, which is more lucrative for businesses. But for individuals, it must be used in their homes, and their home must be used for domestic purposes. The other requirement is that there must be a certificate issued in terms of the electrical installation regulations. And therefore, it is very important that one uses a reputable service provider in installing the solar panel so that they can get the certificate, because as part of the supporting documentation that SARS may require, they would require this certificate. And this panel must be brought into use for the first time on 1 March 2023 up to 28 Feb 2024. So both days are actually inclusive, and therefore any panels that have been brought into play before those dates, or installed before those dates and brought into play or after those dates, would actually not apply. So it is purely just for the 2024 tax year, and all days of the tax year are included. And this credit is limited. It's not a be-all, and you can get any amount that you've used. Effectively, it is limited to 25% of the cost of the solar panels, up to a maximum of 15,000 rands. Some of you who have had these installed would not be happy about the limit, because it doesn't seem to be a lot of money, seeing how much these solar panels actually cost. And if there's any credit that has been actually taken into account by the individual in terms of Section 12B or 12A, this credit will not be applicable. This change will then actually one of those that will be backdated, because the bill has not been signed into law yet, but it will be deemed to have come into effect on 1 March 2023, which is the current tax year that we are in, that ends at the end of Feb. Next slide. The next change is with regards to transfer between retirement funds. Previously, when individuals moved from one retirement fund to another retirement fund, there was this concern that if one does not retire, there may be certain tax implication if one moves from one fund to the other. But what the law now has proposed is that if an individual is moving from a less restrictive fund to a more restrictive fund, there will not be any tax liability incurred by that individual. If then the individual is moving their interest, that interest at the point that they move the fund will be ring-fenced, and therefore it would not qualify for the withdrawal benefit. As we all know, there is there's been a big confusion. I mean, when the minister presented at the midterm budget policy statement, the two-pot system was actually moved to 1 March 2025. But with the labor unions complaining and having stated their case, and at the finance committee meeting this week, it was actually decided that the two-pot system will come into effect from 1 March 2024, much to the disappointment of the pension fund industry, because they don't believe that there are enough mechanisms and that they are ready to actually deal with the withdrawals, and that is being proposed by the two-pot system. But that remains to be seen how that will work practically, because there is quite a lot of unhappiness from the retirement funds with regards to the moving back of this of the two-pot system to 1 March 2024. But the transfer as well with regards to retirement funds, it will also be effective on 1 March 2024. So these two will actually be aligned. The next change, next slide. The next change is regards to contribution made by employers to retirement funds. What has happened in previously is that where an employer has actually contributed to a retirement fund and the individual actually qualified for Section 10102, which is the foreign employment exemption, what that meant is that that contribution by the employer would have been exempt from tax, and the employee would not have paid fringe benefit tax. However, because the amount was in relation to retirement fund contribution, the employee could actually get a deduction against any other income that they may have. If they had passive income, for an example, of rental or interest income, what this meant is that even though the individual may not have been taxed on this fringe benefit, they actually benefited from the deduction, in that they got the deduction as a result of their employer contribution. And this was an anomaly, because if one has not been taxed and has not paid tax by means of a fringe benefit, they should not be getting the deduction. And this has continued with SARS being unaware of the consequences. And the change that is coming into effect is that if one has not been taxed on the fringe benefit, they should not get the deduction. And therefore, also, if they have not been taxed on this fringe benefit, they cannot carry forward, and they have exempt income in total, and there is no taxable income. They cannot carry it forward because they have not paid any taxes, and therefore they cannot get a deduction in subsequent years or against any withdrawals in future. So this is to make sure that they don't get to benefit from not paying any taxes because their income is exempt, but they also get it as a deduction against taxable income. And this change will come into effect also on 1 March 2024. Then the last change, which had quite a few multinationals up in arms and us as tax advisors, because it created quite a lot of uncertainty and a bit of confusion. It is the requirement for foreign employers to actually register in South Africa for PAYE. Previously, there was a bit of mismatch between the SDL Act, the UIF Act, and the PAYE Act, whereas when it came to SDL and UIF, there was no distinction between a local employer and a foreign employer, in that if you had an employee in South Africa, you were required to contribute to SDL. You were also required to deduct UIF and pay it over to the respective authorities. However, from a PYE perspective, you were entitled that them do not withhold PYE and that the employee would then pay the taxes by means of provisional tax. But then the minister said, we are going to align all of these and we are going to require foreign employers to actually register for taxes in South Africa. However, the final wording of the Act actually stated that only if you have a permanent establishment in South Africa as a foreign employer, you are required to register for PYE in South Africa, which at least is a bit of a reprieve, because if you have a permanent establishment, you are then required to register as a company in South Africa, and therefore you would be then able to register with SARS from a PYE perspective and withhold PYE. And that change also will come into effect on 1 March 2024. And that is the last of the employment, savings, and individuals changes. I will now hand over to Louis, who will take you through the business taxes side of changes. Thank you.
Thank you, Dumisa. That was very informative, and I think we all now know what's spotting when it comes to individual taxes. Good morning, everyone, from my side. We do realize that it is a taxing time of the year for most of us, so we really appreciate you making the time to join us for the session today. The first change that I'm going to look at and discuss is the reviewing of the principles of Practice Note 31. Now, Practice Note 31 was introduced in 1994 as a concession to taxpayers who incur interest in the production of interest income without having actually carried on a trade. Now, most of us will know that the carrying on of a trade is a core requirement for deductibility of any expenses in South Africa. So this was a clear concession that has stood for quite a number of years. So just by way of a simple example on the application of the practice note is if we have taxpayer C, a natural person not carrying on a trade, the person borrows 1 million rand from Absa, incurring interest at a rate of 11%, and he on-lends that 1 million rand to taxpayer D, charging a rate of interest of 7%. So under normal circumstances, taxpayer C would not qualify for any deduction of the interest incurred because of the lack of carrying on of a trade, but because of Practice Note 31, SARS will allow taxpayer C a deduction of interest as well as related expenditure, probably the likes of bank charges, incurred on the Absa loan up to the level of the interest income. So it allows for the break-even position for taxpayer C, but taxpayer C can't create a loss. If we go to the next slide, please. The concern from a Treasury and SARS perspective is that this concession essentially bypasses the core trade requirement, which they're not happy with. There shouldn't really be concessions that deviate from core principles. But there is an acknowledgement that the principle plays an important role in various taxpayers gaining efficient access to funding. But of course, unfortunately, there's been some abuse of the provision, or not the provision, the practice note, whereby taxpayers have sought to maximize interest deductions without a corresponding inclusion in taxable income for the related recipient, which has necessitated SARS and Treasury to review this practice note. If we go to the next slide, please. So what is being proposed is that the practice note be withdrawn. That has been on the cards for a few years now, but there is an acknowledgement that further stakeholder engagement is required before that is done. And the idea is for the provision or the practice note to be replaced by a section which then governs the deductibility of such scenarios, and that will come in the form of Section 11 Cap G. And the proposal essentially there is that a person may deduct interest expenditure incurred in the production of interest income in a non-trade scenario, but that the deduction will be limited to the interest income received. Importantly to note there is that the current provision only refers to interest expenditure, whereas the practice note refers to the broader concept of expenditure. So this will be a narrower approach, and this will become effective for years of assessment commencing on or after 1 Jan 2025. The next topic that I want to deal with is clarifying the anti-avoidance rules dealing with third-party backed shares. Now, third-party backed shares in essence are preference shares that are guaranteed by a third party when it comes to dividend yield or return of capital or repayment of capital. And the reason why we have this anti-avoidance provision is that SARS and Treasury says that in a scenario where a third party backs your cash flows and on dividends and your capital, that is akin to a loan where someone has signed surety for the loan, and therefore income that is earned by the funder in the form of dividends should actually be taxed as normal income, because in substance it's really interest income. There is an exemption or exception to that rule, and that is where the funding is used to acquire equity shares in an operating company. The concern with the current provision is that the exception applies or is triggered. So you enter into the exception when you buy a qualifying equity share in an operating company, but there's nothing that prevents you from selling those shares and then still enjoying the exception. And that's clearly not the idea, because we want the funder to be funding a legitimate business acquisition. So the proposal is that as soon as the qualifying equity shares are sold by the purchaser, any dividends accruing on the third-party backed shares after that should then default back into the anti-avoidance provisions and be taxed as normal income. There will be some exceptions to that, and that's, for instance, where the equity shares in question represents equity shares in a listed company, and those are disposed of in exchange for equity shares in a different listed company through a reorganization, or where the equity shares are disposed of and within 90 days thereafter the third-party backed shares are redeemed. And this will come into effect from 1 Jan 2024. Then the next provision, we're going to have a look at CTC. So what is CTC? We're now dealing with companies. So this is not your cost to company, something that we all keep an eye on this time of the year. But this is dealing with companies, and generally speaking, a company's CTC is what its shareholders have contributed to it in the form of share capital and share premium, and it can generally be returned to the shareholders free from dividends tax. And because of that, companies and shareholders alike usually favor CTC, and they've come up with all sorts of interesting schemes in order to enhance the company's CTC levels, because that can then be distributed back to shareholders without triggering dividends tax. There are usually some CGT implications on a receipt of CTC from a shareholder perspective, but in the first instance, there's a general deduction or reduction rather of the base cost of those shares. So usually there's no immediate CGT implications. So again, it's a real benefit to rather receive CTC than dividends. So the concern that has been identified is that foreign holding companies or holdco that hold shares in an SA operating company or SA opco via a foreign intermediary holding company, let's call it interholdco, can avoid SA tax on distributions by changing interholdco's tax residency to SA. And the reason for that is the wording of the CTC definition, which says that when a foreign company becomes a South African tax resident, its CTC is deemed to equal the market value of its shares at that point in time. And that makes sense in a way, because that sort of crystallizes the value of the shares which has been created outside of the South African tax net, which shouldn't really be subject to dividends tax if it's distributed. only growth thereafter really should be subject to dividends tax. So you can understand the rationale behind the provision. But some people have come up with a clever scheme to then uplift the CTC and avoid tax. If we go to the next slide, I'll take you through an example which I find quite fascinating. So I'm just going to spend a little bit of time on this. If we look at the left and start at the bottom, we've got a SA operating company. It has CTC or share capital of R1 million, and it's built up retained earnings of 299 million. And let's assume that's retained earnings based on a fair market value of its assets and liabilities, which would mean that the shares in SA OPCO should equal a market value of 300 million rand. And I'm deviating back to my university days in terms of valuation principles, but I think that is a sound conclusion there. And then we have company B, which is an intermediary holding company, which starts off as a non-resident. And then company B is wholly owned by company A, which is also a non-resident holding company. So if we Sorry, I think you lost me there for a moment. If SA OPCO distributes a dividend to the foreign intermediary holding company of 299 million, then that dividend would be subject to dividends tax at 20%. It might be reduced in terms of a double tax agreement, but off the bat, it'll be subject to dividends tax at 20%. If, however, company B changes its residency from a non-resident to a South African tax resident, its CTC will then become 300 million rand. And that's on the assumption that its market value is limited to the market value of SA OPCO. So that's on the basis that company B doesn't have any other assets or liabilities. So at that point, yeah, we've got CTC in company B of 300 million. If SA OPCO only at that point declares the dividend of 299 million, that dividend is then exempt from dividends tax because it's now a dividend from an SA company to another SA company. Company B then on declares the 299 million to its non-resident holding company, but it does so out of CTC and not retained earnings. And a distribution out of CTC is not subject to dividends tax. So if you look at it, what's happened now is the profit in SA OPCO, which has been generated in South Africa, or the full value of 299 million, flows all the way up to company A, which is a non-resident, and there's been no dividends tax. Provided that company B and SA OPCO don't hold a significant immovable property, company A will also not be subject to capital gains tax in South Africa on the receipt of that CTC. So in order to close these avoidance structures, there's a proposal to change the calculation of CTC for a non-resident becoming a resident. And I'm not going to take you through the full mechanism, but essentially what will happen in this example, once the proposal has been enacted, is that company B's CTC will also end up being 1 million rand. And therefore, it will be liable to withhold dividends tax on any distribution in excess of that to its foreign shareholder. If we can go to the next slide, please. So just something important to note there is that when a South African or non-resident company becomes a South African company, the CTC is determined with reference to all its interests in SA resident company, where it holds at least 50% of the equity shares. And that'll become effective also from 1 Jan 2024. The next slide, please. The next one deals with tax-exempt establishments. We can move one more, please. Okay, and so in South Africa, as many of you will know, we have a number of tax-exempt establishments that can apply for tax exemption. Those typically include public benefit organizations, recreational clubs, and other associations of persons. So there are quite a number of strict rules from a tax perspective to qualify for the exemption. And one of them is that the governance of the establishments must be undertaken by 3 unconnected persons who accept fiduciary responsibility, and there can't be one single person controlling the establishment. So a person from a tax definition perspective includes the likes of a company and a trust. And that's not the intention that a company or trust can sit on the board of these institutions, and therefore there will be amendment to make it clear that only natural persons can accept fiduciary responsibility for these establishments. So the takeaway message is that if you are associated with one of these establishments, remember that in deciding who accepts fiduciary responsibility, you must trust those who accompany you, but they can't be a trust or a company. Hope that's clear. Okay, our next amendment is the extension of the sunset date of the urban development zone allowance, and that's governed by Section 13 Quat. So just as a reminder, the allowance is an accelerated allowance for buildings that are constructed or improved, which are housed in the demarcated urban development zones as an incentive to uplift those areas and renew them. So it's quite a lucrative allowance if you do qualify for that, and there's been some concern that we're reaching the sunset date. Now, I realize that as South Africans, we love sunsets. You know, you often see majestic sunsets. We love the sun, but these days, when we hear sunset, some of us get a bit nervous because it means our solar panels are not able to charge during the dark hours. So any extension of a sunset date is most welcome. So this sunset date will be extended to 31 March 2025 to allow for further consultation with stakeholders on this allowance. If we go to the next one, and I realize that people at this time of the year, if we can just move one slide, please. Okay, at this time of the year, we tend to only think about the upcoming R&R, but it's at this time we're just going to focus on R&D for a moment. So we have a Section 11 Cap D research and development allowance that's been around for a while. The uptake on it has been somewhat disappointing, but it in part has resulted from very complex, the section is very complex, so it's difficult to understand it and apply it. And there's also been numerous delays from a government department perspective in getting these approved because pre-approval is required. So in a nutshell, the section provides for 150% incentive. But as we go through it, you'll see that you need to apply about 150% of your mind to understand some of these concepts, which is partly why we're seeing some amendments in order to simplify and also to lower the bar or the barriers to entry into the allowance. So what is of concern is that the definition currently doesn't really emphasize that the allowance should be limited to scientific and technological research and development. It also contains a very complex intellectual property criteria test, which is focused on an end result. And we really want people to try and innovate. And when you undertake a complex research and development project, you are not guaranteed of any end result, but that shouldn't discourage people from attempting to find new solutions and new technology. So there's a bit of a shift in the proposals to move away from a clear end result from day one, but rather looking at complying with the criteria of undertaking research and technology development and analysis. Also, currently, internal business processes are excluded from the incentive, and that's not necessarily the intention because where companies can enhance their internal business processes and in the process come up with new technology. That, of course, is good for business and for the fiscus. So that will be addressed. And then when it comes to software and computer programs, there's also a very limited entry into the R&D section, and that will also be addressed by the amendments. So if we go to the next slide, the proposal is that the words scientific and technological will be introduced throughout the section to emphasize that that is the ultimate objective. And then there's also an introduction of a competent professional test for obviousness. And that is to ensure that we are trying to come up with research and development and intellectual property and come up with something new that is not readily deducible by a person skilled in the relevant scientific and technological field. So developing a software program which might be new to me and not that obvious, but someone who's skilled in the field will quickly tell me this is not new, so you won't qualify for the allowance, as an example. And then, as I mentioned, the internal business process will not automatically be excluded, and it needs to be measured against the definition of R&D. And if it does qualify, then potentially you could then apply for the allowance and qualify for it. Due to the delays also with getting these projects approved by government, and as I mentioned, you need pre-approval before you can deduct the 150% allowance. There's also now proposed that there will be a 6-month grace period, which means that expenditure that qualify that you incurred within the 6 months before approval would then also qualify for the allowance. And then in line with the likes of POPI and protection of information, there will also be new sanctions for breaches of security. And of course, from a competitive perspective, we don't want SARS to alert our competitors of something new that we are trying to develop. So if this goes through, SARS officials that break the secrecy code on this section may face a fine or up to 2 years in prison. Then another sunset clause, don't get stressed. This has nothing to do with solar. This will also be extended up to December 2033, sorry, which is very much welcomed. So that gives people another 10 years to do some research and development. So let's all bring out our inner Elon Musk and go out there and do some research and development. If we then move on to the last amendment from my side, and this is also very much welcomed, and this is a provision that was introduced during the budget speech in February, also to address the energy crisis in South Africa. Dumisa did touch on the incentive for households effectively, but this incentive, which is contained in Section 12, Cap B, Cap A, is aimed at businesses. And in order to qualify for this deduction, you need to meet the in production of income requirement, which is where most households will fall flat. And the incentive is a 125% deduction of cost incurred in a renewable energy project that starts producing electricity and is brought online. It must be new assets, new and unused rather. And the dates in question must be brought online between 1 March 2023 and 28 Feb 2025. Any renewable energy method will qualify, so it's not limited to solar. It could include hydroelectricity generation, gas electricity generation, and I'm sure there are many others that I'm not aware of. And there's also no limitation on the amount of electricity being produced. Our current provision that deals with these deductions has a 1 megawatt differentiation in terms of capacity. Projects below 1 megawatt gets 100% deduction in one go, whereas those producing more than that get a 3-year deduction at 50, 30, 20. So if we go to the next slide, please. This provision is obviously more favorable in that it gives you 125% deduction, whereas the others come up with 100% over time potentially. So it's quite amusing to me that they need to make the point that that you can't qualify for the current provision as well as the new provision. So you need to decide which one you pick. And I would venture to say that if you select the smaller provision that allows a smaller deduction over a longer period of time, such as what's applicable to small business corporations, then you might end up staying a small business corporation. So although I'm not a mathematician, the 125% surely is better than 100%. They also make it clear that if a portion of your project is funded by a government grant, then you can't claim the allowance on that portion. And then, of course, also to discourage people who come up with clever avoidance schemes. If you do bring this project or a project of this nature into producing power and you qualify for the allowance and then you go and dispose of it within before 1 March 2026, then you will have to recoup up to the 125%. Disposals after that date would only be subject to a recoupment of the cost and not the additional 25%. And now that we all feel renewed and energized, I'd like to hand you over to my Electrifying International tax colleague, Hilton Cameron. Thank you.
Thanks, Louis. So I'm briefly going to be dealing with some international tax issues. There weren't too many issues. So as we go to the next slide. So the first issue I'm going to look at is what we refer to as the foreign business establishment, and that applies to controlled foreign companies. So each year since controlled foreign companies were introduced in the legislation, there has been amendments to controlled foreign companies, and one needs to keep tabs of those. The current issue, which if I call it is in vogue, and that's because of the coronation case, which David will talk about later, is what we call the foreign business establishment. So just to take a step back, the issue is, do you have a controlled foreign company? And basically that is a company offshore, which South African tax residents own more than 50%. It's a little bit more complicated than that, but we'll just leave it at that. So the issue is you have a controlled foreign company, and now the starting point is the income of that company is taxed in the South African shareholders' hands. And one of the exemptions which stops that taxation in the SA shareholders' hands is, does your controlled foreign company have what we call a foreign business establishment? And in simple terms, without going into the technical issues, but I'll get a little bit more into that, is, does your controlled foreign company have substance? Are there people on the ground who have an office, and does your office have equipment which runs the controlled foreign company? So the issue, as I said, was earlier in the year we had the coronation case, and there was no FBE, a foreign business establishment, in that case. And then SARS was, I think, presumably concerned that there might be some issues with that case. So in July of this year, when the draft bill came out, they proposed to amend the foreign business establishment rule, which basically said in order to have your foreign business establishment, all the important functions of the business all important functions of that business must be done by that CFC. So at the moment, the current wording is just that you need to conduct the primary operations, and that's now been, well, it was enhanced to say that all important functions must be done by that CFC. So what happened is, in our view, that was extending this definition and making it more difficult for South African taxpayers to meet this definition, which makes it more difficult for South African taxpayers to compete on the global front. So the definition, well, the amendment has been removed in the 1 November amendment. So we're quite happy about that. But just to confirm, or to put a caveat with that, SARS has, or Treasury has unashamedly said that this removal of the amendment is subject to the Constitutional Court judgment on the coronation case. So as I said, I don't want to go into David's case, but the issue is the coronation case has gone to the Constitutional Court, and my understanding is it's going to be heard in December. So there is, depending on how that case goes, there is still chance for this amendment to be reenacted in January, depending on the Constitutional Court judgment. So just be aware that the FBE, there may be amendment to the FBE still, and one needs to just watch that to still make sure your controlled foreign company meets the necessary definition. Next slide, please. Yeah, this it's pretty specific, but there was a, let's just call it a possible loophole for certain people. Basically, if you had a foreign company which is listed on the South African Stock Exchange, then the dividend paid to the South African tax resident was or is currently exempt. The concern with SARS or Treasury is that basically some of these companies invest in notes in South Africa. So the South African company paying the interest is going to get a deduction. And in certain scenarios, the foreign company was not taxed on that income. And then basically it could declare a dividend, and that dividend was not taxed back in the South African shareholders' hands. So SARS was concerned about that and is basically going to cut down, if I can call it that, loophole, which is rather specific. There is a slight, if I can call it, light at the end of the tunnel for certain taxpayers, and basically if that interest is less than 20% of the profits, then you'll still get the exemption, but it's rather specific. If we can go to the next slide, please. So again, this is what we call the participation exemption, and this is when a South African shareholder disposes of their foreign company. So currently the rule is, and I won't go into the full details, but basically if you own more than 10% of your foreign shares and you've held a shareholding for 18 months or more, and you dispose of your shares to a non-resident who's not a connected person, the disposal is not subject to capital gains tax. And just to be clear, that means there's no gain or loss. So SARS is concerned that there are certain loopholes, and as you can see, the amendment is effective from 1 November 2023. Well, at least it will be effective when the act is enacted, and it's going to be backdated to when the final bill was provided to the public. And in terms of this amendment, basically the CGT exemption will no longer be applicable if you sell to a non-resident and that non-resident was part of the same group of companies within the 18 months prior to the disposal. And the other removal from the exemption is if you sell to a non-resident, if the shareholders of the company that acquires the shares immediately after disposal are substantially the same as the shareholders of any company in the group of company disposing of the shares. So there's quite a mouthful, but basically if your shareholders who are selling the shares are similar to or substantially the same as the shareholders who are acquiring the shares, the CGT exemption will not apply. Of course, one of the issues here, the wording is substantially the same. And what does substantially the same mean? No one knows exactly what they're looking at, but one would think you at least need to have more than 50% of similar shareholding. Next slide, please. This is, to me, it's quite a big change, but it wasn't really unexpected in view of the change that was ready to happen to trusts and CGT. So the current issue is if a South African trust distributes its income to its beneficiaries in the same year of assessment, normally it's quite easy. The beneficiary is taxed on the income as opposed to the trust. However, SARS is concerned about distributions to non-resident beneficiaries. And these days, as you know, there's been quite a lot of people who have ceased to be a resident and have moved offshore. So the issue is now SARS now has to tax those non-resident beneficiaries, and they are concerned about the practical issue of taxing those non-resident beneficiary as opposed to simply taxing the trust. So the new amendment, which is going to come into effect on or after 1 March 2004, is if that trust vests any income to a non-resident beneficiary, the trust will be taxed on that income, and that's at the 45% rate. So that's quite a big change for trusts, and they need to be aware of if they are distributing any income to non-resident beneficiaries. Just some possible concerns, which SARS seems to think or Treasury thinks there are no concerns. In terms of double taxation agreements, you can't treat residents and non-residents differently. And if they do, there's an issue that there's a non-discrimination clause in a double taxation agreement that says you can't. But SARS is of the view that there is no discrimination based on a person's residency. Personally, I don't see how you can say there's not a difference because the one is taxed and one is not taxed. However, they have such view. And the other issue is there can be 2 levels of taxation. So if you vest the income in a non-resident beneficiary, the trust will be taxed. And then for the actual beneficiary, in terms of their local law, wherever they are now living, they may be taxed as well. One would hope in the foreign country they would get a credit for the tax that's paid by the trust, but that's going to depend on the local law and possibly the double taxation. But just to be aware that if you are vesting any income to a non-resident beneficiary, there are potential 2 layers of income, also 2 layers of tax, one in South Africa and one in the foreign jurisdiction. So care should be taken on such vesting. Next slide, please. So this is the last slide, and actually, strangely enough, this is as amendment to the Income Tax, not to the Tax Administration Act, but it doesn't really have much different. And this is something that's new, and I'm not a transfer pricing expert at all, but just to mention it for people, is the introduction of new advanced pricing agreements. So this is basically where you go to SARS and you tell SARS we want to enter into a transaction with a foreign person, and you want approval of that transaction with SARS in terms of transfer pricing. Just to take a step back, I'm sure most people are aware of transfer pricing, but what is transfer pricing is when you have a transaction between a South African party and a non-resident who are connected. That definition has been expanded, but we'll ignore that for now. The issue is your transaction must be at arm's length. And what is at arm's length? And our transfer pricing colleagues will give you a whole long story about what is arm's length. But the issue is you can now go to SARS and get an agreement to say what is arm's length. This is obviously just coming out now, so we're not sure how exactly it's going to work in terms of the fee that you're going to have to pay SARS to specify what the procedures are. But the act, when it comes into play, there will be by public notice. SARS is going to issue documents to say what exactly is going to happen, what's going to happen with the fees. We don't know what capacity SARS has in this regard, and what they are going to say is they're going to initiate a pilot to see how things are done, and to get input from other jurisdictions, and they'll take it from there. I don't know how one gets onto the pilot, but to me, it's a good thing for South Africa to say that we are going to provide the service. Practically, how well it works is going to be another issue. That's it from the international tax side. If I can hand over to Cliff, he's going to look at the VAT and customs.
Hi, good morning, everyone. I must just apologize. I've got an irritating cough, so if I do accidentally cough in your ear, please excuse me, but I'll try not to. Yeah, so the first, I've got quite a few industry-specific amendments, so that would be applicable to some of you. So yeah, if we can go to the first one. And that is the VAT treatment of specific supplies in the short-term industry, insurance industry. Now, previously, SARS issued Private General Ruling 14, or what we call BGR 14, that included a Section 72 ruling to accommodate certain situations where the insured pays the excess of an amount directly to the third-party supplier, and then also where the insurer also pays then the remaining amount to the, especially if you think about a panel beater where the excess is the insured is paying the excess and the insurance company would pay the remaining amount. Now, as you all may know, is that in 2019, all Section 72 rulings were withdrawn from 1 December 2021. So that's necessitated a change in the VAT Act to allow for those circumstances. Now, Section 88 of the VAT Act is now being proposed to be amended to include for those specific situations, and it's now deemed that the supplier, being in my example, the panel beater, would now deem to make a supply to each person that is liable to pay part of that consideration, and should also then issue separate tax invoices to each of such person. Now, there are also further amendments that will be promulgated to also cater for other scenarios that where, say, for instance, the insurer pays the full amount and then recovers the excess from the insured. And then also what documentary requirements should be kept in that instance. And this proposal is effective from the 1st of January 2024. Next slide, please. Now, the next one is just to clarify the VAT treatment of prepaid vouchers in the telecommunications industry. We've seen now with the recent MTN cases that there are quite a significant amount of supplies that these telecommunication service suppliers actually provide. From my age, the vouchers were only used for calls and SMSs, but recently you can almost acquire anything with the amounts on your mobile phone, such as financial services, long-term, short-term insurance, loans, downloads of music and movies, and then also mobile money services. Now recently we've dealt with you can actually buy food with your cell phone when you're hungry and you haven't got cash with you or your card with you. So the issue comes in, and then in the voucher that the telecommunication company actually issue is dealt with in Section 1019 of the VAT Act, and that is subject to 15%. Now, where these subsequent supplies now could either be exempt or taxable, but that the telecommunication company actually acts as agent on behalf of those third-party suppliers. Now, the issue is that it could actually result in a double VAT in the sense that the telecommunication company charged VAT on the issue of the voucher, and then the third-party supplier will also now need to charge VAT on the supply if it's a subject to VAT at 15%. And now the telecommunication companies could not issue a credit note to reduce the output tax, because they, if you look at how these vouchers are actually issued, it could be anyone, the vendor down the corner of the street that can actually issue the tax invoice. So the telecommunication companies could not issue a credit note to cancel out the initial supply of the voucher. Now, the proposal is that Section 21 of the VAT Act that deals with credit notes is that telecommunication companies may deduct an input tax through the issuing of a credit note where the subscribers acquire services from third-party suppliers, whether taxable or exempt, where these telecommunication companies act as agent on behalf of those various suppliers. This change is also effective from the 1st of January 2024. Next slide, please. The next amendment is the rules dealing with the documentary requirement for gold exports. Now, if you're in this industry, you would know that it's quite technical in the sense that it's quite regulated. But in most instances, depositors will deposit gold or ore with a refining company, which would then refine the gold or any other metal that can be in there. But it's most of the cases, it's the depositors that do not have sufficient gold or ore to substantiate or to qualify for an export. So the refining companies would then commingle quite a few of these depositors' gold or ore into one smelting process, and that more or less loses the identity of the specific depositors' gold or other metals. Now, specifically with gold is that these depositors now need to provide SARS with sufficient documentation to substantiate the zero rating of the export of this specific gold on a transaction by transaction basis. But because of now the gold being commingled with other depositors' gold, it became quite difficult in order to do that. Now, the proposal is that Section 54 of the VAT Act is amended. Now, Section 54 of the VAT Act deals with all, agents and auctioneers. Now, it's introducing a provision that would allow the agent, which is now the refining companies, to act as an agent on behalf of the depositors, and they are now responsible to retain the necessary documentation, the export documentation, to substantiate that zero rating. Now, what's important here is that those refining companies now need to assume the liability for not just obtaining, but also retaining those documents. So if there's any event of non-compliance, the agent would be responsible for the adjustment to the VAT to 15% because the zero rating cannot be substantiated. Quite a big risk for those refining companies. Yeah, this amendment's also effective from the 1st of January 2024. Next slide, please. Again, with the valuable metal industry, the regulations dealing with the domestic reverse charge mechanism is proposed to be amended. Now, there are quite a few of them. I'm going to go through each one, what the issue is, and then also what the proposal is. But there was an uncertainty of whether the definition of residue only relates to the mining operations or it included a residue as a general concept. Now, this is now being proposed to be clarified that the residue is only in connection with mining operations by a holder of this specific Mineral and Development Act certificate, or any person contracted by such holder. So it's not just a general concept. The next one is that the phrase of goods containing gold in those different forms, that someone or some people actually interpreted to be that the gold must be in those specific forms. Now, it is the regulations also going to provide clarity in the sense that it is not just the gold, but it is the actual goods that must be in that form that should contain the gold. And then the definition of valuable metal resulted in some unintended consequences in the sense that it included all goods containing gold. Now, as I understand, all electrical equipment also contains gold. So there's a bit of an unintended consequence that if you sell a second-hand TV or a laptop, that the domestic reverse charge should now apply because it's goods containing gold. Now, there's going to be almost like a de minimis rule implemented in the sense that the goods that are applicable should not, or the goods excluded should not contain, or should contain less than 1% of the gold in gross weight of that specific good. And then also gold-plated jewelry where the gold is present in a minor constituent, that should also be excluded from the domestic reverse charge. Then the last one is that in certain instances, the recipients do not know what the content of the gold is in the goods that they acquire because they haven't got the necessary methods to determine that. So now what is proposed is that the responsibility to declare the percentage of the gold content of the valuable metal in such good is now transferred from the recipient to the supplier of the metal. So when the supplier now sells these valuable metal to the recipients, that they should also now provide them with the percentage of the gold content in that valuable metal. Now, these regulations will come into effect when the actual regulations are promulgated. Next slide, please. And you can move to the next slide as well. Yeah, just as an addition, as you may know, that the diesel refunds are specifically for certain primary activities like mining, farming, fishing, forestry, and those specific activities. Now, with the energy crisis that we have had for quite some time, and the increase in the fruit prices, in the budget speech of 2023, Minister of Finance then also indicated that the diesel refund system is going to be extended to the food production, the manufacturers of food products, and then also can claim a portion of the diesel that they use in the manufacturing process. Now, what's important is that this is only limited for a period of 2 years, from the 1st of April 2023 until the 31st of March 2025. Hopefully, the Minister will then also extend that going forward. Next slide, please. But similar to all the other primary activities, there are numerous requirements, and SARS would definitely want to see that the amount that is claimed is actually eligible. So there are quite a few definitions that must be met, like the definition of foodstuffs. I've provided a few examples there, and also certain activities or foodstuffs that are specifically excluded, and that normally includes all the things that are bad for us. So yeah, you know, when you want to apply for this diesel refund scheme, is to ensure that you meet all these requirements. Then also the activities of manufacture was also specific. But what is interesting, and that's based on case law, is that with the primary activities, the activities that are listed in the regulation is limited to those that are listed in the regulation. But in this instance, it specifically says, but is not limited to the following activities. So if there are specific activities that qualifying users enter into that's not listed, that they can also request SARS to also claim the diesel used in those activities. Now, in this specific extension of the diesel refund system, is important that the activities specified, and those are the primary activities, like I previously mentioned, that is administered through the VAT 201 returns. Those are also excluded from this scheme. Now, it's going to be quite difficult if you have, say, for instance, a farmer that actually farms up to a certain point and then also manufactures, and that could include just the packing and measuring of foodstuffs, and that has got a separate facility or business premises that just for that, in the sense that it's now being administered through 2 separate systems. And I'll get to that now. The one is under the VAT return, and this specific system now. What's also important is that the manufacturing premises is also defined, and that it excludes certain premises as well, which also includes a de minimis rule, where if there's more than 10% public accessible portion of the trading area for wholesale or retail, that premises is excluded. And then also where it's wholesale or retail distribution or sale of the goods occur. Next slide, please. So in order to register, qualifying users must apply for the registration. This is done through completing and submitting the application, the DA 185. So it is not the one administered through the VAT Act or through the VAT return. And this application should also be accompanied by a detailed floor plan of every single business premises according to scale. And that also includes or indicates the purpose and use of all the areas within that specific premises. That is just to ensure that non-eligible activities are not included in the overall diesel usage of that. And the information of each manufacturing premises must be separately submitted. So users cannot submit a consolidated application of all their premises countrywide, and premises in a specific customs area must be submitted in that specific customs area. Next slide, please. Now, when it gets to the claims process, all claims, you can just, it is effective from the 1st of April 2023. Now, even if you register now, you can retrospectively claim from the 1st of April 2023. Although this specific extension is not managed through the VAT system, users must be registered for VAT purposes, although it's not included in the VAT return. So those, like the farmer that the example that I used, it's two separate claim processes. The claim should be included or submitted through the DA66 form with all necessary supporting documents supporting that specific claim. Now, it says all necessary documents. Now, there's quite a few documents that must be submitted, but what we've heard in the industry is that it's going to be similar to the VAT returns that's got a verification audit, that those documents submitted will also be subject to verification. I'm now going to hand over to David that's going to discuss notable tax cases.
Hello again, everyone, and thanks very much, Cliff. Yeah, I thought we'd just finish off by looking at two important tax cases. The first one being Coronation, as Hilton alluded to earlier, which grabbed all the news headlines from an investor's perspective in Coronation for all the wrong reasons. Let's go on. Thanks. Yeah, you can see there the graph of how the share price in Coronation reacted when the news broke of the Supreme Court of Appeal finding in that SCA case. So what that dip in the share price represented was a drop in the value of Coronation of about 11% in 1 hour following the Supreme Court of Appeal ruling. It was estimated that between 800 and 900 million rand was the total potential liability over all the different tax years that could be in issue as a result of the interpretation handed down. And that drop also represented more than R1 billion in value that was wiped off. So certainly that makes it clear that tax liabilities are an important component of the valuation of companies, if anyone ever doubted that. Okay, next slide, thanks. So just to go into the background of the case, it was actually the 2012 year of assessment that was in dispute. And SIMSA, as I've abbreviated it there, stands for Coronation Investment Management SA. And that was a South African tax resident. Then we had Coronation Global Fund Managers Limited, which is CGFM. That was a wholly owned subsidiary of CIMSA, and it was incorporated in and tax resident in Ireland. Now, just to understand really what the case was about, is that we've got Section 9D of the Income Tax Act that deals with controlled foreign companies. And basically, it's an anti-avoidance provision. And what it does is that it says that if South African residents collectively hold more than 50% of the participation rights or voting rights in a non-resident company, that unless one of the specific exclusions applies in 9D, that those residents pro rata to their participation rights in the CFC have to include, in effect, the taxable income of that controlled foreign company pro rata to their shareholding, their participation rights in their taxable incomes, and declare it and include it in their taxable incomes in South Africa. And you would calculate the taxable income of the CFC as if it was a South African resident. It's not a South African resident, but as if it was. In other words, on a worldwide basis and so on. So what was at issue here was whether CIMSA, that was tax resident, had to include 100% of this taxable income, the net income of the CFC, which was CGFM, in its taxable income, in CIMSA's taxable income for the year that was in dispute. And what was important was that one of those exclusions in Section 9D, where you don't have to attribute the income back to the South African shareholders, is if the income in the foreign jurisdiction is attributable to a foreign business establishment as defined in Section 9D. So the question came down to, was the income of CGFM attributable to a foreign business establishment as defined? And there, let's go on and just have a look at the next slide, because the definition of FBE is obviously important. Because if a CGFM had this FBE, and if the income was attributable to the FBE, then Section 9D wouldn't have applied, and it wouldn't have had to include the income. If it didn't have the FBE, then it did apply, and it would have to include all the net income of CGFM in CIMSA's income. So the definition there is a fixed place of business which will be used for 1 year or more, conducted through one or more offices, shops, factories, warehouses, or other structures, located in a foreign country, suitably staffed with on-site managerial and operational employees of the CFC who conduct the primary operations of that business, suitably equipped for conducting the primary operations of that business, with suitable facilities for conducting the primary operations of that business, and as well, the sole or main purpose in locating that fixed place of business outside of South Africa must not be SA tax avoidance. Now, in the tax court, the issues that were at play were 4 to 7 on that list. So 1 to 3 were common cause. There was no dispute about that. They had an office, they had a fixed place of business, was located in Ireland. The questions were all around 4 to 7, which SARS disputed, all of those. I think let's go back, Sebo, thanks to the slides. So CGFM had a fund management license, which included the functions of investment management, administration, and marketing. It actually said collective investment management in the fund management license. CGFM elected to outsource the investment management services to the UK and South Africa. So that wasn't done in Ireland, the investment management. And they outsourced the custody and distribution functions as well. The custody was outsourced to Ireland and the distribution functions to South Africa and the UK. Was of the view that the primary operations of CGFM were not conducted at its office in Ireland. What they did have in Ireland was, as I mentioned, they had an office in Ireland, and there were 4 staff in Ireland. There was the managing director, 2 accountants, and a compliance officer. And so, and what those 4 staff did in Ireland, the activities were directed at maintaining the company's investment license and managing the company's ability to offer the opportunity for clients to invest in the international collective investment schemes offered by Coronation. So those activities that were done in Ireland, which were essentially directed at maintaining the license and the company's ability to offer the opportunities to investors, that was what was referred to by the taxpayer as fund management, which was what the taxpayer said actually the primary operations were. That was fund management as opposed to investment management. Although investment management was included in fund management, the taxpayer said, well, that's not the primary operation. That's not the primary focus. It's just one of the functions of fund management. And SARS was of the view that the primary operations were actually investment management, which wasn't conducted at its office in Ireland. The SARS said that the requirements of an FBE were not met. They then assessed the tax liability of CIMSA for the 2012 tax year to include the entire amount of the net income of CGFM on the basis that the FBE requirements weren't met, therefore Section 9D applied, etc. So the question was, whether CGFM actually had a foreign business establishment as defined in Ireland. Let's go on. Next slide. So in the tax court, which is of course where CIMSA then appealed the matter to, the court had to determine the applicability of the FBE exclusion. That was what they were seized with there. And they had to then determine whether CGFM met the requirements of having an FBE. And that entailed deciding, what actually were the primary operations of CGFM. And the distinction between investment management and fund management found favor with the tax court. So what the tax court said was that fund management is multifaceted. It's obtaining and securing the correct licenses, ensuring compliance with laws and rules, and deciding where to invest. Whereas the tax court said, investment management is less complex than fund management. It consists of growing the investments over time. And they said it's relatively minor in the overall picture of fund management. And so the tax court held in CIMSA's favor, and it set aside SARS's additional assessment. So SARS wasn't happy with that decision, and then they appealed with leave of the court direct to the Supreme Court of Appeal. We can just go on. And then before the Supreme Court of Appeal, essentially they had to decide what were the primary operations of CGFM. Was it investment or was it managed outsourcing as alleged by the taxpayer? So essentially, was it really an investment company or a management company? It was common cause that the investment function wasn't located in Ireland. So in other words, if the primary business was found to be investment, then the net income of CGFM would be properly imputable to CIMSA. And so CIMSA's arguments in the SCA was that primary operations are the practical actions required to operate the business. And they said that the outsourced functions were not functions conducted in Ireland on a daily basis, which of course one of those was investment management that was outsourced. They also said that investment management wasn't actually part of CGFM's license, and therefore that it can't be the primary operations because CGFM wasn't licensed to conduct investment management. And they said they stuck with the view that their daily business was that of fund management as opposed to investment management. Just to repeat, Fund management is the activities in maintaining the license and managing the ability to offer opportunities to clients to invest. The court then said, the Supreme Court, that investment was a key operation. And they looked at a number of things, and quite strangely for this day and age, one of the things was their memorandum of incorporation of CGFM, which amongst other things entitled them to do investment management. They also looked at the license and they disagreed with Coronation's argument that investment management wasn't included in what they were licensed to do, because the license included collective investment management, which then included investment management. So the Supreme Court said. And also CGFM's primary source of income was from investment. So the Supreme Court said that the outsourcing of investments did not transform the primary operations of the company away from investment. Essentially, that you can't outsource what are the primary operations and then still claim that you've got an FBE in that particular jurisdiction. And then CGFM lacked the staff and facilities to conduct investment management in Ireland. And on that basis, they upheld SARS's appeal and said that the net income of CGFM would be imputable to CIMSA. So on that basis, the taxpayer then lost. And as alluded to earlier, this case is going before the Constitutional Court shortly. And it's going to be very interesting to see the approach that the Constitutional Court takes, because it will have to be looking at constitutionality ultimately, as well as maybe just the cold wording of the FBE exclusion as it is at the moment. Of equal interest, actually, was that, if you can go on to the next slide, Sibo, thanks, is the question about penalties and interest. So yeah, what happened was that you've got the understatement penalty regime, as I'm sure most of you are aware, under the Tax Administration Act. And unless a bona fide inadvertent error exists, and one of the behaviors or a substantial understatement is present, then an understatement penalty must be charged. SARS bears the onus of proof of what behavior and the penalty that's applicable. But what SARS went for here was substantial understatement, which is a 10% penalty. But they also went for the penalties for underestimation of provisional tax, the para 20 of the 4th schedule penalty, which is a kind of double penalty. But just take note that one can have this duplication of penalties. The penalty regime does cater for that. And SARS relied on the fact that the taxpayer didn't want to make available to them an opinion that the taxpayer had obtained from a tax expert as evidence of mala fides. But the court said, well, there's essentially no compunction on the taxpayer to make that tax opinion available, and you can't use that to infer mala fides. So they weren't happy to accept that argument by SARS. The court found that there was nothing to suggest that tax returns were not submitted with the bona fide belief that the FBE exclusion may be applicable. And so the imposition by SARS of understatement and the underestimation para 20 penalties, all the penalties were in fact thrown out by the SCA. But what was of interest was last year we had the Thistle Trust judgment. And in the Thistle Trust judgment, SARS raised the argument that if a taxpayer has taken a certain position deliberately in the submission of its tax return, that one can't then say that there was a bona fide inadvertent error and use that as an out from the penalty regime, because you've actually knowingly taken a certain position. And in Thistle, the Supreme Court of Appeal held that isn't correct, that in fact there can be a bona fide inadvertent error, even if the taxpayer has taken a position that the court subsequently finds to be incorrect. So that also threw the cat amongst the pigeons at SARS, and I understand that they are cross-appealing that finding. And the court in this case, in Coronation, on the basis of Thistle, also said that for that reason that it was a bona fide inadvertent error, and therefore that the penalty regime should not apply insofar as the understatement penalties are concerned. And they didn't really go into why the underestimation of provisional tax penalty shouldn't be imposed, but there SARS could in any case remit such a penalty if there was a serious calculation of taxable income at second provisional time. So presumably on the, they just took the view that all the penalties shouldn't apply and that there was a serious calculation done. On the question of interest, so under Section 89 Quat, there is interest on the late payment of taxes, underpayment of provisional taxes specifically. The only out, though, is if it's due to circumstances beyond the taxpayer's control, which seems to go against any volition on the part of the taxpayer, whereby, for any reason of volition, the amount of tax was underpaid, which would occur in very, very few circumstances. So anyway, one would expect interest to have been payable, and the court found that it was. So that was the basis, to cut a very long story short, of why the share price went down so dramatically on the 8th of February of Coronation. And that's the first case. The second case that I thought that we should look at is just one of an example of a number of cases that essentially dealt with very similar things. If we could go on, please. And the case I chose was that one of ABSA. Sorry, just go back a slide, Sibo. Thanks. Yeah, ABSA, Commissioner versus ABSA. As I say, there have been a number of these cases that have all dealt with the jurisdiction of the High Court to hear tax matters where the taxpayer has bypassed or attempted to bypass the usual tax court objection and appeal process in terms of Section 105 of the Tax Administration Act. So very, very unusually this year, we've had, at least 5 cases, ABSA being a 5th one, that have dealt with this question about whether the taxpayer could bypass the usual tax court route and go directly to the High Court. We had, for example, Rapper Resources, United Manganese of Kalahari, Forge Packaging, and the Erasmus case, and now as well as ABSA that dealt with this thing. And the provision in the Tax Administration Act that's relevant here, Section 105, that says that a taxpayer may only dispute an assessment or a Section 104 decision by SARS under the dispute resolution provisions unless a High Court otherwise directs. So it does give an out where one could perhaps approach the High Court. So the question has been around this jurisdiction of the High Court and in what circumstances would it be appropriate for the High Court to otherwise direct that the taxpayer may bypass the usual process. Thanks. If we could go on. So to just give a background to what happened here in ABSA, SARS initiated an investigation into ABSA Bank and other entities in 2018, and their audit covered the tax periods 2015 to 2017. And at the conclusion of the audit, SARS issued notices in terms of Section 80J of the Income Tax Act that indicated that they intended to apply the general anti-avoidance rules, the GAR provisions in Part 2A of the Act, due to what had, in their view, been an impermissible tax avoidance arrangement to which ABSA and its subsidiary had been a party. So what happens is that if SARS intends to apply the GAR provisions, the general anti-avoidance rules, to a taxpayer, it's got to, before it actually issues the additional assessments on that basis, issue the Section 80J notice to the taxpayer, stating that it intends to apply the GAR, why it intends to apply the GAR, and then giving the taxpayer 60 days to provide reasons why the GAR should not be applied. When ABSA got that notice, it then submitted a request to SARS in terms of Section 9 of the Tax Administration Act to withdraw the notices. Because they said that the application of GAR was tainted by an error of law, because the notices indicated that SARS had acknowledged that ABSA Bank wasn't part of an avoidance arrangement, or more specifically, that they were ignorant of the avoidance arrangement. So what had happened here had been that ABSA had a wholly owned subsidiary called United Towers. And ABSA and United Towers had subscribed for preference shares in a Macquarie structure. So they had subscribed for preference shares in a company, which in turn subscribed for shares in another company, which made a contribution to a trust. And that trust had then invested in Brazilian government bonds, bonds issued by the Brazilian government, which in terms of the South Africa-Brazil double tax treaty, on the interest on those bonds isn't subject to tax in South Africa. And so SARS had alleged that ABSA was a participant in this arrangement, which they said was a tax avoidance arrangement. And what SARS then sought to do was to tax the preference dividend income received by ABSA and United Towers in ABSA and United Towers' hands, and not regard them as exempt preference dividends, because they said that they were part of this tax avoidance arrangement. Now, what ABSA alleged was that they were ignorant of the fact that the investment in the Brazilian government bonds had taken place. So they said they were ignorant of this, and their legal argument was that one can't be regarded as a party to a tax avoidance arrangement if you are participating in ignorance of the tax avoidance part of the arrangement, which sounds like a very plausible argument anyway to me. But that was their legal argument. And the whole question, though, with the High Court really, hinged around whether the High Court had jurisdiction, and then also went to the merits of the issue. At least in the High Court it did. So what then happened was that SARS informed ABSA that the notices would not be withdrawn, Section 80J notices. SARS disputed the submission by ABSA that it was not part of a tax avoidance arrangement, and stated that the objections should in any case be addressed in the process of responding to the notices that had been issued, and that they shouldn't be done by asking for a Section 9 review. SARS then proceeded to raise additional assessments on ABSA and United Towers. Next slide, please. And ABSA then approached the High Court for a review of two things. The first was a refusal by SARS to withdraw the Section 80J notices, and then a review of the additional assessments that SARS had issued. And what the High Court found was that the decision not to withdraw the Section 80J notices was administration that was susceptible to review, not necessarily under PAJA, but under the principle of legality, which basically is the exercise of power by a government official. So even though it wasn't a final notice, they said that it was reviewable under the principle of legality. The High Court said that SARS was bound by the facts in the notices as disclosed by Absa Bank, because SARS didn't appear to challenge the question that Absa had no knowledge of the wider scheme in terms of which the Brazilian government bonds had been subscribed for. And so therefore, in the High Court said, well, the facts aren't really in dispute, because SARS hasn't disputed the fact that Absa didn't and United Towers didn't have knowledge of this investment in the Brazilian government bonds. So therefore, it is a pure point of law dispute. And they said that because it's a pure point of law dispute, we do have jurisdiction to hear it, because they said that the High Court has jurisdiction to hear matters that constitute exceptional circumstances, that in exceptional circumstances you can bypass the standard tax court procedure, and questions of, if it's just a pure question of law, that does constitute exceptional circumstances, and that gives Absa grounds to directly approach the High Court. So the High Court then granted Absa's pleas. They upheld the grounds of review. They found that the notices and assessments had been unlawful because GAR shouldn't have applied, because Absa couldn't be a participant in a state of ignorance of the wider scheme. And then they set aside the notices and the assessments. And then with the leave of the High Court, the issue then came before the Supreme Court. Next slide, please. So SARS then approached the Supreme Court. This was, by the way, a unanimous decision of the Supreme Court. The issues as framed by the Supreme Court were three. Firstly, whether a decision not to withdraw a Section 80J notice is reviewable prior to or after the issuing of an assessment, whether the High Court was correct to characterize the challenge as being wholly a question of law, and if so, whether the High Court was correct in its determination of the dispute. Next slide, please. And the Supreme Court of Appeal decision actually got no further than the question of jurisdiction, of whether the High Court in fact had jurisdiction and should have entertained the matter. So what the Supreme Court found was that the refusal to withdraw a Section 80J notice can have no adverse effect or impact upon a taxpayer. They, in effect, said that because the issuing has no effect until assessment. It's only when an assessment is actually raised that it can have an adverse effect upon a taxpayer. They said that the High Court had correctly held that the issuing of the notice, Section 80J notice, did not constitute administrative action. But then they said that as a matter of logic, if the issuing of a Section 80J notice doesn't constitute administrative action, that the refusal to withdraw a Section 80J notice, to keep it extant, in other words, can also not constitute administrative action. And then in relation to the review of the assessments, they said that Section 105 of the TAA applied and confirmed the principle that the High Court will only exercise its jurisdiction in exceptional circumstances, and appeared to accept that a pure point of law could constitute exceptional circumstances in terms of which the High Court would have jurisdiction to hear the pure point of law dispute. But they said that the High Court was wrong in finding that SARS had in fact accepted and was therefore bound by the facts as disclosed by Absa Bank. They said that the Section 80J notices issued by SARS didn't actually state that Absa had no knowledge of the broader scheme, and they were merely a statement of reasons why GAR applied. So that the High Court was wrong to infer that SARS was bound by the facts as disclosed by Absa Bank, that they didn't have knowledge of the broader scheme. that the participation in an arrangement and whether it constituted an impermissible avoidance arrangement involved questions of both law and fact. That the High Court had therefore erred in its characterization of the dispute as being wholly one of law, and therefore it was incorrect to find that exceptional circumstances were present to entitle it to exercise its jurisdiction to hear the matter. So in other words, they said, well, you know, it's not really a pure point of law dispute. Had it been a pure point of law dispute, you would have had the jurisdiction, the High Court, to actually entertain the matter, but it wasn't purely one of law. So the SCA upheld the appeal with costs and set aside the orders of the High Court, and the application was then dismissed with costs. So these matters, you know, these cases that I referred to earlier, and in all of them, the taxpayer lost, and it was found that the High Court, for one reason or another, didn't have the jurisdiction to hear the matters, that these are now being appealed, or at least most of them are being appealed to the Constitutional Court. And so it's going to be very interesting to see what the Constitutional Court finds in terms of whether, you know, the High Court does have jurisdiction and under what circumstances it has the jurisdiction to hear matters. And so that the taxpayer may, you know, if these decisions are overturned, be able to approach the High Court in future to, you know, without going through the whole slog of going through the tax court process, especially if it's just a pure point of law that's in issue. So very, very important to see what the Constitutional Court finds. Okay, that concludes our presentation. I'd like to thank all of you for, see most people have stayed on, and thanks very much for doing so. As mentioned earlier, recording will be emailed to, or a link to a recording will be emailed to you, as well as the slides themselves. And thanks very much again, and all the best. Please don't hesitate to contact us if you've got tax issues. We'd like to assist you, and our contact details are there on that last slide. Okay, so thanks once again, and all the very best to you. I hope that you have a great festive season and that you manage to get some good downtime over the festive season. All the very best.